Class 3, Principles of Technical Analysis. Welcome back to our series on technical analysis in financial markets. If it's your first time here, make sure to check out our previous classes and, of course, subscribe to the channel so you don't miss anything. Today, we will delve into the basic principles of technical analysis, an essential component for understanding how to identify and take advantage of trends in the market. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. So, let's get started. What is technical analysis? Technical analysis is a methodology that seeks to evaluate and predict the behavior of asset prices based on past data. Unlike fundamental analysis, which focuses on an asset's intrinsic value, technical analysis deals with the behavior of the market and how historical prices can help us make informed trading decisions. Foundations of Dow theory. Dow theory is the foundation of technical analysis and establishes several key principles. Prices reflect all information. Price movements reflect all available information in the market, whether economic, political, or psychological. Markets move in cycles. Economic cycles alternate between bullish and bearish periods, and it is crucial to identify where an asset is within this cycle. Economic cycles refer to fluctuations in a country's economic activity, alternating between phases of growth, bullish, and contraction, bearish. Bullish, upward phase, or bulls. In this phase, the economy is expanding. There is an increase in production, employment, and income. Investors are optimistic and tend to buy more assets, which drives prices up. The term bulls comes from the way a bull charges. Upward, symbolizing growth. Bearish, downward phase, or bears. In contrast, during this phase, the economy contracts. Production, employment, and income typically decrease, leading to distrust among investors who tend to sell assets. The term bears comes from how a bear attacks, coming down from above, symbolizing falling prices. This use of bulls and bears has become popular in financial markets to describe the trend of the market over a given period. Identification of trends. By analyzing charts, we can identify trends that will help us predict future changes. The trend is your friend. Following the prevailing trend is key to maximizing profit opportunities. Tools of technical analysis. To conduct effective technical analysis, we have several tools. Trend lines. These help us identify the market direction. They can be upward, when the price is rising, or downward, when the price is falling. It is essential to connect the lows in an upward trend and the highs in a downward trend to establish these lines. Volume. This is an indicator of the strength behind a price movement. High volume suggests that the movement is more likely to continue, while low volume may indicate weakness. Supports and resistances. Supports are price levels where an asset tends to stop and reverse its direction. Resistances, on the other hand, are levels where the price encounters obstacles in continuing to rise. Knowing these levels is crucial for identifying entry and exit points. Chart patterns. These include reversal patterns like head and shoulders, double tops, and continuation patterns like triangles and flags. These patterns are indicative of potential future movements and help traders make decisions. Indicators and oscillators. Tools like the RSI, Relative Strength Index, and moving averages help identify trends and moments to enter or exit the market. Types of trends. It is essential to understand the different types of trends to trade correctly. Primary trend. This is the general direction of the market over the long term, can be bullish, bearish, or sideways. Secondary trend. These are movements that occur against the primary trend, either as corrections or rebounds. Tertiary trend refers to short-term movements that can be challenging to predict but are crucial for daily trading. The importance of volume. Let's talk a bit more about volume. This indicator not only shows the number of shares being traded, but also provides information about the asset's liquidity. High volume can indicate that the market is active, and there is a higher likelihood that prices will continue in the current direction. Remember, to accurately assess volume, it is helpful to multiply the number of shares traded by their price to obtain the total volume in monetary terms. V times P equals V, where V is volume, P is the trading price, and VE is volume in euros, liquidity. Chart patterns, continuation and reversal figures. Chart patterns are fundamental in technical analysis as they help traders identify potential future price movements in assets. They are divided into two main categories: continuation figures and reversal figures. Continuation figures. Continuation figures indicate that the current trend, whether bullish or bearish, is likely to continue after a brief pause or consolidation. These patterns suggest that the market momentum is intact and that the prevailing trend will continue. Ascending triangles. This pattern forms when there is a horizontal resistance line and an upward trend line. The price makes higher highs while the lows remain within a range. Generally, it indicates that buying pressure is accumulating, suggesting that the price could break upwards. Descending triangles. This pattern is characterized by a horizontal support line and a downward trend line. The price makes lower lows and tends to consolidate. This pattern usually indicates a continuation of the bearish trend, as it suggests that selling pressure is dominating. Flags and pennants. Both patterns develop after a strong movement and are typically short in duration. Flags are slanted rectangles in the opposite direction of the trend, while pennants are triangles. Both indicate that the previous trend is likely to continue after a brief consolidation. Rectangles. This pattern occurs when the price oscillates between two horizontal levels of support and resistance. It is a period of consolidation that can indicate that the price will move in the direction of the previous trend once the rectangle is broken. Reversal figures. Reversal figures indicate that the current trend is about to reverse. These patterns are crucial for identifying entry or exit points, as they can signal a change in market sentiment. Head and shoulders. This pattern forms after a bullish trend and consists of three peaks: a high peak, head, between two lower peaks, shoulders. The breakout of the neckline, which connects the low points, suggests a change to a bearish trend. Inverted head and shoulders. This pattern is the opposite version of head and shoulders and forms after a bearish trend. It indicates a possible reversal to a bullish trend once the neckline is broken. Double tops and double bottoms. A double top is a bearish reversal pattern that forms after a bullish trend, indicating that the price cannot break above a resistance level. A double bottom is its counterpart and signals a possible reversal to a bullish trend, indicating that the price cannot fall below a support level. Technical indicators. Technical indicators are tools used to analyze price action and can be classified into several categories. Here are some key types: trend indicators, moving averages, smooth out price action to help identify the direction of the trend. They can be simple, SMA, or exponential, EMA. MACD, moving average convergence divergence, indicates changes in the strength, direction, momentum, and duration of a trend. Momentum indicators, RSI, relative strength index, measures the speed and change of price movements. Values above 70 indicate overbought conditions, while values below 30 indicate oversold conditions. Stochastic compares an asset's closing price with its price range over a specified period, indicating overbought or oversold conditions. Volume indicators. Volume simply measures the number of shares or contracts traded over a period. An increase in volume can confirm a trend. OBV, on-balance volume, combines volume and price to show buying or selling pressure. Volatility indicators, Bollinger Bands, consist of a moving average and two lines that indicate market volatility. When the bands widen, it indicates an increase in volatility. Moving averages. Moving averages are another vital resource. They are used to smooth out price action and can be simple, exponential, or weighted. By observing moving averages, traders can identify the general trend and make informed decisions about when to enter or exit the market. Conclusion. Today we covered the fundamental principles of technical analysis, key tools, and how to interpret trends in the market. Remember that mastering technical analysis takes time and practice, so don't hesitate to continue exploring these concepts. In our next class, we will dive deeper into how to apply these principles in real trading situations. If you enjoyed this class, don't forget to like and subscribe for more content. I would also love to read your comments and questions in the section below. See you next time.